Good afternoon and welcome to the AAMA mid-quarter market commentary. I'm Bob Baker, President of Advanced Asset Management Advisors, and joining me today is my business partner and AAMA's Chief Investment Officer, Phil Voelker. Hey, Phil.
Good morning or good afternoon.
Yeah, how you doing?
Good.
Good. Well, in the middle of a quarter, we just kind of like to go through a couple questions and kind of follow up on some of the things we've talked about in our most recent market commentary. And probably one of the largest things we've had to deal with, and the press has certainly addressed this, is the Federal Reserve and whether they think there'll be additional interest rate increases or pausing or potential cuts in interest rates. Phil, can you kind of give us your perspective on all this?
We're back in another cycle, and they're happening quickly. The recent CPI report was fairly positive. It was fairly benign, and that led the market to take any hikes off the table. And the market is essentially pricing in 4 rate cuts next year. And to sort of put that into perspective, the market has done this 5-6 times in the last 15 months, shortly after the Fed started increasing rates. And each time the Fed has responded by some hawkish rhetoric and sort of talking the market out of the position it's taken. There hasn't been much of that recently with this last CPI report. So it remains to be seen whether the Fed's going to try to talk the market back or not. A couple of things as background. The core PCE is still at 3.6%, which is a 6-month high, annualized monthly number. And the PCE services is at 5.4, which is an 8-month high. 6-month moving averages on those numbers have started to improve, although the services PCE just ticked up a little bit on a 6-month basis. We still think that the Fed's going to want to see at least 3 months, if not more, of their core PCE and services numbers meeting their target. They've always cited that as their favorite inflation measure. It's the most stable. It's always the lowest, at least until last month. But so it was always looked at as a easier bogey for them to meet. And so I would expect they're going to stick with it. So there's more to do on the inflation front. And as I mentioned, these short-term cycles in the market, they come and go. The last one all happened within 1 month. People will remember that just a little over a month ago, the 10-year Treasury hit 5%, and the Fed was almost giddy about it because higher 10-year rates means tighter financial conditions, which they track closely. They were suggesting that maybe they wouldn't have to do any more tightening because the market was doing it for them. And then, 2 weeks later, the 10 years down by 50 basis points. So the market gave them something to cheer about and then took it away right away. So all of this has led to continued volatility in the Treasury market. Estimates are there's probably $1 trillion of leveraged positions and hedged positions in the Treasury market from hedge funds, where they hold extensive positions in Treasuries, hedge them with futures, and try to pick up a few basis points. But that just adds more volatility to the market day by day.
And, the crazy part.
Jury's still out. Sorry.
Yeah. And the crazy part in all this is that when the 10-year went from 5 to call it 4.5, long-term mortgage rates fell dramatically, and they fell so much that on average, within a matter of 3 or 4 weeks, it's calculated to be able to save people almost $200 a month for the life of their mortgage just with that uh, decrease in mortgage rates in 3 or 4 weeks, and that's just mind-boggling when you think what that could do to the housing market. To refuel things there, which could potentially cause even more inflation because of home prices. So,
Yeah, well, mortgage applications ticked up, and the media was heralding that as a great indicator. But the tick up was almost non-existent. You almost couldn't even see it on the chart if you looked at the long-term trend. Applications are down so much from their peak. But yeah, it's potentially the beginning of a reversal of that trend.
right. We've talked about the size of the Fed balance sheet and how it's exploded astronomically during the great experiment of the last 15 years. And we've seen about $1 trillion um, of balance sheet reductions in the last 3 to 4 months, but there's still a long ways to go. And can you talk a little bit about how that could potentially affect the markets, or what you see?
Yeah, you're right. It's down a little over $1 trillion in the last year and a half. Currently at about 7.5 trillion. It's still 3 to 4 trillion above what it really needs to be based upon the size of the economy, or just its long-term trend. So at this rate, if the Fed does continue for another 3 or 4 years, they'll get there. But at $1 trillion a year, it's going to take a while. So, and the reserves held at the Fed from the banking system are still elevated as well. Probably about $1 trillion excess in reserves held at the Fed by the banks. So ample reserves in the system. Continued quantitative tightening will reduce that.
And we thought we were striving for peace in the Middle East, and now we've got another uh, potential significant war and the potential expansion of that war. How do you think that, along with the Ukraine, could affect the markets?
Well, looking at the Ukraine situation, the big spike in commodity prices that was the result of the kickoff of that a year and a half ago is behind us. There might be a few isolated incidents of certain commodities. And of course, Russia is a large producer alongside, so they have the potential to affect those markets. But pretty much that war has wound down because the Ukrainian offensive was not successful, and they're running out of troops to send in there. So it's back burner, it seems, with what's going on in the Western Asia or the Middle East. And everybody knows there's a lot of players in that situation, allies, former allies, the axis of evil, however you want to describe all the different players. But it seems to us that unless there's a significant escalation that involves oil transportation or oil producing facilities, it probably is not going to have a big economic impact. There's been discussion for 50 years about Iran. All they have to do is sink a couple ships in the Strait of Hormuz and clog up all the transportation. That's never happened. It could happen any day, would certainly affect the markets. So really, I think the key for investors is from a risk standpoint, is a spike in energy prices, which of course would upset the inflation picture and also be a big negative for economic growth.
Yeah, and over the years, there's always doom and gloom someplace in the marketplace. Can you kind of review how we're positioning things right now to try to find some opportunity or value or defensiveness?
Yeah, we're positioned pretty well where we have been for several years because we identified a high risk market back in late 2019. It's almost 4 years now. And since then, there's been a lot of volatility in the equity market. The market on the upside, in particular this year, has been led by the quote Magnificent Seven, the large cap tech and telecom companies. So it's a very concentrated market. The valuation of those companies is elevated. The rest of the market valuation is not so highly valued, which means that there's less risk in the rest of the market when you look at it without those seven companies. So there's risk, obviously, across the board, but less risk in the more defensive sectors of the market.
Well, and as we know, it's always important for investors not to let their emotions get in the way and bail out of markets, but focus on their long-term investment objectives and kind of stay the course and have some flexibility in modifying positions like we do within portfolios. But anything else you want to cover today?
Yeah, I would just follow up on that and say, in these kind of environments where there's elevated stock market valuations, at least in certain sectors, and there's elevated risk on a geopolitical basis, it's important to include volatility of earnings and stock prices in one's analysis, which we have always done and have been pretty successful, I think, at delivering lower volatility for our clients and their portfolios.
Absolutely. Well, again, we'd like to thank everyone for your time today. Hopefully, we've shared some insights that'll help you in working with your clients and in working with our portfolios. Till next time, thanks for listening.